in that year, grew our revenue 50% more than the year before and burned 50% less capital.
I think you guys have been going through a lot of cost cutting while still getting growth, kind of in this recent post 2021 environment, and facing decisions of you guys could definitely raise around and blow out revenues more and more and more, but there's a whole lot of considerations to get into. We have R&D credits in the US, but they're nothing like the way it works up there.
Absolutely. So SR&ED stands for scientific research and experimental development. For software companies, it's generally 66% of your spend on your product team comes back in the form of cash. So I think that, Gusto looks like Chase in the next 20 to 30 years, or is like comparable in size. And I think Humi can look a lot like TD or RBC or some like one of the larger Canadian financial institutions.
Yeah, I mean, if you think that you're processing $2 billion in payroll now, that should be able to reach $10 billion. If you think about companies offering the Canadian version of a 401k retirement account with matching, you could layer on top there. Just sounds like such a valuable business. If you were the tiniest slither of Fidelity or Vanguard, with a regulatory moat making it difficult for people to become one of the 9 companies that can electronically, disperse payroll in Canada, just sounds like a good business to own.
For me, it's an exciting business to run. This is the trade-off that needs to be considered in like, do you become an international software provider or do you go deep on your, existing geographic market? Because I have a ton of conviction that Humi can be $100+ million company or significantly more, just focused in Canada and within the subset, in focusing on SMBs and supporting the people that work at those companies.
Hello, and welcome to Fireside with the VC. My name is Andrew Romans, and today we're with Kevin Kliman, who's the CEO of Humi. Kevin, good to see you.
It's great to see you. Thanks for having me on, Andrew.
Yeah. So full disclosure, we invested in you guys in, I think, October of 2019, and then again in the last round out of our latest fund. And right now, just real fast, I think you guys have been going through a lot of cost cutting while still getting growth, kind of in this recent post 2021 environment, and facing decisions of you guys could definitely raise around and blow out revenues more and more and more, but there's a whole lot of considerations to get into on that. So I think that's what I want to focus on today's podcast. Is that cool with you?
Yeah, absolutely. Happy to get into.
So before we get started, why don't you explain what you guys do? Who is Humi?
Yeah, absolutely. So Humi helps Canadian companies employ their people. And so we build our platform as an employment system of record, specifically built to support Canadian companies. In the States, there are a small handful of companies that look like us, Gusto, JustWorks, Rippling, and we do this specifically for Canada. A lot of these businesses don't cross borders in the way traditional B2B SaaS companies do, because a lot of the internals are like important features of the platform are regulated financial products that look completely different, whether you're in the US or Canada or Australia or Europe, whatnot.
For example, how many companies, and I know the answer, how many companies are legally allowed to do electronic payroll transfers in the country of Canada?
Absolutely. So just for context, in the US, there are about 2,000 different payroll providers that can remit taxes for you. In Canada, there are 9.
9. Yeah, that's crazy. So you're one of those 9. Okay, so tell us more about like what the breadth is, because payroll is a part of the puzzle, but it's not the only key piece.
Yeah, absolutely. So payroll infrastructure has been a really big and important part of our business. Also, health benefits infrastructure. So being a central hub to employ people, you want to be able to hire them, pay them. In Canada, health benefits is an important feature of a lot of companies' employment packages, so support that as well. We've recently introduced R&D tax credits up in Canada, referred to as SR&ED. This is also a meaningful program specifically designed to help companies in Canada invest in innovation, but more so employ people doing innovative work.
Yeah. And by the way, I want to really pause and make sure this gets the shred thing is really well explained and then what you're doing with it. Because I mean, it used to be a lot of American VCs just don't invest outside the United States, including Canada.
Hmm.
And we invest in the United States and Canada. But for us, for our US taxpayers, and we have a lot of international LPs, including all across Canada in our funds. But when we invest in a US company and we make a gain, we're basically paying zero tax on the big hits that take more than 5 years to get, unless you're not a US taxpayer. In Canada, we're going to pay capital gains tax, but there's a lot of reasons why we like investing in Canadian companies. And one of them is this SR&ED program. So explain how it works. I mean, we have R&D credits in the US, but they're nothing like the way it works up there.
Absolutely. So SR&ED stands for Scientific Research and Experimental Development. It is the official name of the program. And effectively, it's an annual reimbursement on spend towards innovative work. And that means different things based on the type of company you are. For software companies, it's generally 66% of your spend on your product team comes back in the form of cash. So for a
I
lot
thought
of
it was 70. I thought the number 70 is it more fully burdened 66 or is it that it was never 70?
And so it depends on the type of employment. If you're contracting somebody versus full-time employing somebody, it will differ.
Okay.
So there are different variations. Generally speaking, 66, you can say 70% is pretty close to the spend. It's an interesting subsidy that allows for venture dollars to go much further up in Canada.
And how is it paid back? And like a granular example, you're paying 100,000 CAD to somebody who is in some sort of R&D capacity, from software engineering to biotech, even I believe. And so $66,000, you're paying the payroll of the 100K.
Yep.
Then it's like the end of the year or something, right? That you know a specific date when you're going to get 66K dropped into your bank account times all the engineers you've got, right?
In its most simplistic form, yes. You at the end of the year, you do your tax filing for the business. Alongside the tax filing, you submit your SR&ED claim. It's a part of the filing if you end up doing it. And then if and when that claim is approved, you get the $66,000 back in cash. And I think in the States, there's some limited amount or number of years you can participate in the program for. There's no limit to the number of years you can claim SR&ED. A lot of the boundaries around size of company and revenue, when you get to become like a much bigger company or super profitable, it doesn't apply or applies in a much different way. But for the vast majority of software companies, especially ones who are venture backed, it's normally annually a 66% reimbursement in cash on their R&D spend.
And so what time of year with your average tax claim being filed, you know, when is Santa Claus coming to town giving funding basically to startups that need funding, right?
Yeah, so most companies have their year end December 31st. A company has to submit their year end within 6 months.
Okay.
And so it really depends on how quickly the company is able to both produce the R&D claim, which is a good amount of work, alongside their tax filing. And so, if you're ready to file your taxes in January of the next year and the SR&ED claim is ready to go, and they approve it super quickly, you could theoretically get the capital by February, which is massive. It doesn't always work that way. Sometimes companies are audited. There are nuances to the program, but generally it is extremely helpful for stretching dollars for a lot of software companies who are based in Canada.
Okay. And I think you guys, when we spoke, like even just a few weeks ago, I think you were saying that you guys are processing over 1 billion of Canadian dollar payroll every 4.5 months. And that's
Mhm.
probably growing. Just to put it in perspective. So you guys have like perfect optics into what your clients are spending. And then it starts to fit into the picture of how they should do cash management, treasury management, raising the next funding round, what their expenses are as these SR&ED payments come in.
Yeah, so the salary spend is really important for informing and putting together the SR&ED claim. which is why we ventured into the business. So the analogy I like to use when talking about it, in the same way that for a lot of companies, when they do their 409A, they'll just naturally do it with their cap table provider. It's usually Carta. Because like for one, you don't have to engage a third party outside consultant that doesn't have access to your data. And two, it's normally a much better process and less expensive. The analogy holds up in a lot of ways. We have access to a ton of the information that you need to put these claims together. And then the secondary thing is that because we are aggregating service providers, we can provide the service at a much lower cost than any third party like outside consultant could.
Okay, so you're doing it lower cost, and then you were basically doing both, fixed salary, income, payroll payments, as well as hourly contractors. So you were already kind of digitally documenting everything along the way, is my
Correct.
understanding.
Yeah. So one of the big pains around putting these claims together is having to chase clients for information and data pulls.
Okay.
So it simplifies things off the bat. And because we're also, we're an innovative software company. What we do is we productize services. It's kind of like how we've grown the business over time. So at launch, this business is a tech enabled service for us. And we've dedicated product resources to automate and productize the journey of putting these things together. And
Right.
no different than how Carta came to market. They just brought a whole bunch of like really high quality auditors internal, did them at a lower cost, provided a way better experience for the customers who were on their platform. Over time, as they learn more and more about this, they productize more and more. And when you do a 409A on Carta now, it's completely streamlined, super easy to do. I don't even think it's an extra cost. It's probably like directly baked into the value you get. That's what we're hoping to achieve with the SR&ED business line that we launched. And it goes hand in hand with helping Canadian companies employ people. It is a material contributor to the base cost of an employee for a lot of companies. So
Yeah, totally. You certainly don't want to get caught up in you're struggling with the documentation and red tape to be able to take advantage of this program that the government's offering, which is, a key driver for having startups, up in Canada from our perspective. And so at a higher level, I kind of bring the helicopter up and look down. What is the profile of a customer for you guys, and how has that evolved since we started supporting you guys?
So we first came to market 8 years ago. We were predominantly focused on the local tech community and other startups. And over time, we've graduated to supporting more and more traditional businesses. So our profile has gone from like 90% tech to like less than 5% tech.
Less than 5% tech now? Oh my gosh.
5-ish%. Although I will say that, the majority of the companies on our platform tend to be white collar, like office salaried workplaces. A lot of the challenges for the different time-based types of work, businesses that are based off time-based work have very nuanced challenges that over time we'll continue to like solve and then add to our ICP. So
Okay.
today the mix is a lot healthier than it was in the beginning.
Yeah. And what's the range in headcount for companies that you've been servicing, and how is that changing or evolving?
Yeah. This is one of the most difficult challenges in building this type of business. There's so many, like the product you build for sub 10 versus 10 to 100 versus like 100 to 500 versus 500 to 1,000 plus is very different. And then even within those employee count buckets, there are a ton of different verticals with different needs, employment needs. And when we launched, we had a very light product that was good for smaller tech companies. As we've evolved, we've gotten to a point where we have an excellent product for 10 to 100 person plus businesses. So there are hundreds and hundreds of companies who are more than 100 employees on Humi, but that is not like the core focus of the platform. Our average company size is about 35.
Okay.
And you see, like, you don't see the micro businesses using a lot of the like HR, health benefits, more comprehensive employee system of record tools. So like if I would describe it today in the most broad terms, I would say 5 to 500 employees is like the bucket of customers we play in. We build a product for like the 10 to 100, and it just is naturally better for some that are smaller and some that are larger.
I remember your win rate was really high within a certain band, and then, but you started getting inbound and picking up customers with over 500 employees, and that started being interesting to see how the overall segment of the market you're addressing was evolving.
It's been interesting, and we've certainly garnered a whole lot of learnings from picking up customers. In the past, if when you put like when anybody's product is nascent, you pick up customers that you don't fulfill all the core functions for, you're forced to either build that thing internally or support it with people,
Hmm.
or make some like more informed decisions about how you build the business and who you're building for. And so we started very broad and have really narrowed down as we've matured as a business and have like learned more about the product and the market and our customers. It's been a journey,
Yeah,
and
yeah.
its focus is one of the more interesting challenges of this particular business.
Yeah, it sounds like if you do everything your customer's asking you to do, that could, lead you in a lot of different directions. What element of marketplace is there within your business today? Because you guys seem like a central point for, even bringing multiple outside vendors that could ultimately be doing business with your customer now.
Yeah. So one of the beauties of this type of business is that it is a core system of record and is not a huge share of expenditures. So, running payroll and managing um, important like employee information is a core base need of any business. And at $5 to $10 per person per month, you're just not going to cancel that when things get tough. You always need it, and it's not going to really hamstring the business in a material way.
Okay, so
Um,
when you're going through line items of what do we want to cut, for costs, this is not something that you're going to flick the light switch off
yeah, absolutely. Like
on the
when you have
lifeblood of the business.
5 different PM tools like Asana and Airtable and Miro and whatnot, you're probably going to aggregate that down to one. Um, there's very, very few instances where a company is going to cancel their payroll provider as a like means of saving money or like gaining efficiencies within their
Yeah.
operation.
And so on this journey that you've been on, we've lived through kind of ZERP environment, growth at all costs,
Mhm.
free money, raising capital. Talk a little bit about how your perspective changed on getting healthy and trying to reduce your spend on a monthly basis while delivering growth. I mean, you managed to do both, which is pretty amazing, from our perspective. You were cutting expenses meaningfully and continuing to deliver growth and then extending runway. And you've got the option of not raising money or the option of raising money. So maybe talk about some of your journey thinking there.
Yeah, so massive, massive kudos is due to our team who have had an incredible focus the last like year and a half ish on being more effective with our dollars and getting the business to look more like a sustainable long-term thing. One of the, I think, most interesting learnings of my last 8 to 10 years of building this business is that, when I started the company, I'd subscribed to the TechCrunch, like you start a company, you raise all the rounds, you have an outcome.
And you
You
went
got,
through Y Combinator too, which is like,
yeah, exactly.
like they kind of put nitroglycerin in every gas tank rather than gas. And if eight explode and one makes it. So
Yeah,
you,
yeah.
so,
So like I drank all the Kool-Aid, and I today have a much more critical lens on that stuff. So it's not to say that fundraising is bad, but it's very clear that if you can fundraise at points in the company where you have a high amount of leverage, that creates the best outcome. And at the earliest rounds, sometimes it's traction, sometimes it's revenue, sometimes it's talent. for us being a post Series B company, it's maintaining a certain profile of growth, retention and expansion, and not needing to depend on outside parties for capital. And my I don't know, I guess my take on it now is we'll have the best result with engaging in like a third party for capital or whatnot when we don't need them effectively.
Okay, so raise money when you don't need money is what I'm hearing.
Yeah, or sorry, raise money when you have high leverage and high conviction in spending that money. So even if we were at, somebody came to us with very attractive terms today, if I didn't have a ton of conviction in deploying that capital to have a great return on it, it wouldn't be the right move to take the capital.
Okay. And when right now, I think it's okay to say you guys are just around 20 million of ARR right now. Is that fair to say?
Sure. Or
So
north.
to
No,
kind
it's
of
0 and 100 million.
between 0 and 100 million. Okay, we'll go with that. So with having gone through the health exercise while still delivering growth and showing that you could grow at a material clip while substantially bringing down spend, what is your view on increasing market share within the Canadian market? And I also understand that when Canadian companies grow outside of Canada, you continue to grow with them. So you support the Canadian company that's got employees outside of Canada. Isn't that true?
We do, but I have to be intellectually honest. I don't think we're a great fit for those companies. A lot of the
Okay.
companies that start crossing borders today, we don't have an EOR product or an international payroll product. The companies that we're fantastic for are the Canada domiciled and focused businesses, which you don't see a ton of them in the tech blogs, but it is 95% of SMBs play in that category.
Okay.
So
Of
that
what
is
you've got there.
yeah, the idea of market and is really interesting because you look at the States and there's 30 million SMBs or so. In Canada, there's 1 or 1.2. It's a very different market, different supply on an annual basis, and different level of churn. It changes a lot of the ways you can invest and where diminishing returns start to exist. For us, the economics of a customer is very important. And understanding how to attach the additional revenue lines or pieces of value that we can provide for a company is the thing that makes our economics look really, really attractive. And so as we've doubled down on being more effective as a company, attach rate and providing more value for companies has been an important component of that. As it is, similar to the States, the largest volume bucket is in the smaller companies, but it also tends to be where the worst economics are on just strictly a software basis. The thing that builds the moat for us is with these additional services, making companies at that scale very attractive in a way that a lot of other companies wouldn't be able to. So, we've heard Gusto, JustWorks coming to Canada for years, and Rippling's, recently popped in. If you can only provide a fraction of the value that we can, it changes the way you can invest in companies at each of the different buckets of employee size.
Yeah. And we may have to edit this out, but I know you've spoken about layering on completely different services onto what you've got already, that if you're able to see kind of consistent performance numbers for this certain cross section of the SMB market in Canada, you could be positioned to become a debt provider or offer other kind of capital services. Is that something that you can openly disclose? Or
yeah, absolutely. So this is has been part of my thesis for a number of years, and we've actually seen some of the faster growing HRES providers in the States and around the world start to play this thesis out. The financial products that are naturally attached to the employee system of record make up some of the most valuable products for the largest financial institutions.
So things like factoring, or what are you thinking?
Yeah, so like some of the more obvious products are early wage access, and early wage access leads to credit products and personal or commercial bank accounts. The other thing that is, we do health benefits. We're also licensed to be able to provide government savings accounts. So in the States, I think it's 401k. In Canada, it's called RSP, same idea-ish. But we're one of the strongest signals for being able to refer somebody to that type of product as we build the base of companies. And we have over 5,000 companies, 150,000 individuals. We should be able to run that up to 1 million people as the business continues to grow. If you start to launch these products, each of them ends up looking like a business comparable to some of the largest financial institutions in Canada. That's where you start to see massive value. One of the things that's inspiring for me to take a look at historically, a lot of the largest financial institutions in the world, they tend to come to exist when there's some material customer acquisition cost advantage. And I see the employee system of record as just that.
Right.
When Chase brings an individual in, they're spending money on like naming rights for a football stadium and tons of TV advertising, and they're offering like a free iPad for $200 when you sign up. When we bring a company onto the platform, we bring 30 individuals on who we have 95% of all the information needed to sell those additional financial products. We build a level of trust with them through their employer that a lot of financial institutions are dying to be able to establish. And it just sets us up really well to be able to expand into those things into the future. And so if all these companies are patient enough and continue to progress our products and over time, I think that Gusto looks like Chase in the next 20 to 30 years, or is like comparable in size. And I think Humi can look a lot like TD or RBC or some like one of the larger Canadian financial institutions.
Yeah, I mean, if you think that you're processing $2 billion in payroll now, that should be able to reach $10 billion. If you think about companies offering the Canadian version of a 401k retirement account with matching, or put some money into this and we can manage that for you and give you options on choice and managing these programs. And you're natively coming at this where we're the guys who digitize human workflows and tap into all these data sets with all these APIs, almost marketplace mentality. You think what you could layer on top there just sounds like such a valuable business. If you were the tiniest slither of Fidelity or Vanguard, with a regulatory moat making it difficult for people to become one of the 9 companies that can electronically, disperse payroll in Canada, just sounds like a good business to own.
For me, it's an exciting business to run. This is the trade-off that needs to be considered in like, do you become an international software provider, or do you go deep on your existing geographic market? Because there are companies like Bamboo is a good example. They have a significant business. They do HRIS. They're in 120 different countries. Awesome.
Yeah.
And they're like 100+ million. I have a ton of conviction that Humi can be $100+ million company or significantly more, just focused in Canada and within the subset, in focusing on SMBs and supporting the people that work at those companies.
Yeah, I think, you can give yourself a framework for decision-making on strategy of saying, if it's not leveraging this like zero cost of user acquisition, trust building relationship, then maybe we shouldn't do it. And if it does, let's talk about what does it cost to build that product, introduce it? What are we going to make? What's the payback? Does that increase the kind of lowering churn, that we've got? I had a guy, I had a company, I won't say their name. They were really great guys. They were sponsoring my first book tour, my first venture capital book tour, doing 409A valuations. And they were having tough time competing with SVB, Silicon Valley Bank at the time, because SVB was like, yeah, whatever, I'll do your 409A valuation for free, but basically, where these guys were saying we could be more versatile in how we're willing to do that. It just sounds hard to compete with you guys when you're doing a whole bunch of things for that same target set. But
There's a
so
lot
let's
of,
go ahead.
I was gonna say, there are a lot of things attached to the employee system of record that are being done by consultants, and more manually in the past, that are naturally expensive, that we can reduce the price and improve the experience for. I think that's the simplest way to think of the framework for the potential of the business.
Right, right. Well, and so raising funding kind of keys into this. You've already kind of talked about your thoughts of better to raise venture capital funding when you've got leverage, you're not, burning to a zero cash balance and
That's
they're
that's
chasing you.
that's to never raise it if you can just make a shit ton of cash and grow off that. Not to
Yeah.
say like,
No, listen, I,
yes,
I, I'm a venture capitalist, but I was an entrepreneur before, and there's something to be said about growing a business that just grows on retained earnings. I remember moneysupermarket.com in the UK when I was living there, they went public at $1.2 billion market capitalization, and they had hardly raised any money. It was like they had hardly raised any money. The two founders owned 82% of the company when everything was converted into common, which is a beautiful thing. Even, TMX in Canada, you've got options of going public as a business with such a Canadian story. Whereas in the United States, IPO is not really an option, and that could be the last time you raise money. Whereas the TMX, you could raise money on an initial public offering and a second public offering, and it could be a very good way of, even exposing yourself to more people. And it's nice to have clients invest in your private rounds, but it's kind of like painful to make that happen. If you go public on the TMX or something, that it could be an interesting way of everyone. It's like you're the frequent flyer mile company that they're
sounds
all
so
supporting.
weird. Almost like there's no compliance or anything at any cost. I don't know enough about the go public thing, especially at what would be considered subscale. I think generally speaking, 100 million in revenue plus has been the expectation for SaaS. Feels like that's a little bit higher now. But yeah, there's some interesting markets up here. I haven't done enough on like learning about them as to like what the true costs are being
Well,
a public.
I'll reach out. I'll reach out to the folks at TMX. They used to have people running up and down 101 in Silicon Valley trying to get us to consider going public in Canada, even when there was not much of a Canadian story, saying that, forget Sarbanes-Oxley, the cost is low, compliance is low, annual cost is low, and here's all the advantages. Um, but the world has changed a lot since I've spoken to any of those people. So what another thought we were talking about too is that if you raise money, like just to throw out a story of another company, there was a company, this was actually based in Palo Alto, where the company we got a new customer that we actually introduced them to that was paying 5 million a quarter. So it went from just a couple of POCs to like boom, 20 million revenue run rate. And the
Yep.
New York VCs said, "Oh, let's raise 100 million on like 900 million pre and anoint the latest unicorn." So they were basically like, raise as much as you can. And the guys in Palo Alto were saying, well, maybe we should raise 10 on 40. We'll have a post money of 50 million. And there you could sell the company in an M&A transaction for 200 million and deliver a 4x return to the newest investor that just got on board. Whereas if we raise money at $1 billion post, there's almost no one that can buy this company. And actually, IPO is the only path out of this room with no windows and doors anymore. So, do you ever think about different scenarios of if we raise capital, what does that mean for the exit?
Yeah, absolutely. I think it is especially important to consider your scale on the market. Like for us, being kind of like the growth equity, private equity scale, my general like understanding is that whatever that if you take an investment, whatever value that's at, the expectation is a 3x return on top of it. So,
Right.
congratulations, you raise it 2 billion, you got to exit at 6 billion, which means you probably need like, I don't know, a couple of billion, depending on the company, a couple of billion of revenue. It's really interesting to think about what types of companies need that type of venture funding. Uber seems like a great example of it's a winner take all. You need a international network of these like drivers and this like international network of two-sided marketplaces that all work together in a brand that can like subsist across them. That would seem like a good idea to take a ton of money to move quicker to like win the world. If you're building a like B2B SaaS app that can be like relatively easily producible and like one on sales or can be like built into somebody else's platform, you would think that wouldn't be as good of an idea. And generally I default these days to ownership. This isn't not, it doesn't hold every time, but I think generally the higher the ownership from the operators, the more likely a good outcome is for everyone involved.
Sure. I mean, I guess you're thinking if we take dilution and we potentially increase the liquidation stack, we increase the exit, what an exit needs to be to satisfy, say, a 3x multiple or a 4x multiple of the new investors. What is our conviction of achieving that growth? And is my smaller slice of the pizza, ultimately, a bigger dollar amount? And do I have conviction that our business can go there? I think to some extent with where you guys are, it's a bit tragic if you're not able to execute on saying, hey, we're processing $2 billion of, payroll. We've got optics into all these other marketplace of benefits and services that these people can subscribe to from us. Let's start offering on the consumer side. You can open a savings account and a bank account and you can borrow against it. You can get money ahead of your payday. And on the company side, we know exactly when your shred credit payment is coming through. You can be borrowing against it to smooth out cash flow in between these government balloon payments. There's, I mean, it just seems like there's just so much there that I would think that makes sense to go after.
Here's the big challenge, right? Like these are all logical opportunities. They all require, meaningful investments in time, attention, human capital, and like just capital investment.
Yeah.
And trying to balance that out with being sustainable, the amount of like capital that's available in the market, like, having a valuation of the company that's reasonable given all those things. There's no clear answer. This is the difficult.
Yeah, but these are good.
Part of building businesses. There's really no right answer. And like if you're being intellectually honest, you can kind of win. There's ways to win any different way you go. But I think it's really important for the people building the company to have conviction in the path that is selected. Like you don't want a team who wants to be, cash flowing, small, not like getting messed with by investors, taking a ton of money from a like super formal private equity shops could be in their office every week, like enforcing like, certain limitations on how they work or whatnot. I think
Sure.
being very honest about who, like what a company is and what they want, the path they want to choose is very important for the health of the business and the outcome, because you see often, and I admitted this at the beginning of the show, like some people, you see other people do it and just assume that it's the right thing for you without applying a like critical lens.
Mm-hmm. And what do you think about a kind of, I wrote a book on corporate venture capital where if there's conflicts of interest with the normal VC, it multiplies when you get into the CVC landscape. There's a lot of financial CVCs. Almost everyone's got one, like City Ventures we had for our episode 100 here. Sometimes if you tie up with one of these guys, you're going to shut the door to working with other people. But then again, if you're working with that one, that might just be such a big market that, it completely changes the value of the business. Have you ever considered tying up with a strategic investor? that can also help you layer on some of these
Yeah,
things? Or it almost starts off as a fundraising and turns into an M&A conversation, maybe.
there's so much variance in what those look like within the different companies. Like that type of arm at a like Manulife or a like massive insurer is super different than a fast growing pre-IPO tech company.
Yeah.
They're different signals, they're connected into the company in different ways. They have different mandates of what needs to exist in order to have some sort of partnership.
Right.
Uh, I've seen such a plethora of these things. It is really interesting because it can be a like negative signal. It can be a big boost to the company. You know, we took, I don't want to, we took, we partnered up with a very large Canadian organization that has a crazy number of small businesses on their platform. And the promise was we were going to be introduced into their marketplace, and the amount of business we would get from it would be like more than we've ever seen in our life. They're like, button down the shaft, you know, like prepare the ships, like our sea of volume is coming.
And what
And
happened?
well, can you guess how many customers we got from this partnership?
0. Right, 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 right.
Uh,
Yeah.
Again, but like there's situations where it makes more sense, but it's important to be super critical, like, you know, deploy the super critical thinking when venturing into these waters, because their incentives might not be aligned with yours. In fact, oftentimes they aren't. And for entrepreneurs who aren't seasoned or who haven't dealt with these arms of these companies, it's easy to forget that and get too excited about the potential of the partnership.
Right, right, right. I mean, Brad Felt from Foundry said in my second book, when you're talking to these corporates and Dancing with Elephants, and they tell you what month this is going to happen, don't be afraid to ask what year. Are we talking 2024 October? Or are we talking 2025? They literally might be thinking 2025. Um, so that's an issue. And I think that when you do go through M&A too, sometimes these incentives are not aligned and you feel like we're now going to get more than 0 customers through the acquisition and there's an earnout component, and all of a sudden you're powerless to make that happen and someone else is in charge of it with incentivizes to stop it from happening. So, it's kind of complicated relationship on the strategic CBC fundraising, but also the M&A process. There's something to be said for cash up front, when you have less and less and less control over earnout results, going in that direction. Well, it sounds like, Kevin, you've got a lot of good problems to think about rather than some more challenging programs so many founders are going through on their roller coaster journey. Sounds like the company's just created a ton more optionality by substantially lowering the burn while delivering growth during that tough transition, kind of year and a half that we've been through. So congratulations on all that. Um,
Massive.
Obviously it'd be great, anyone listening to this, if you know any Canadian small, medium enterprises, tech or not tech, we love introductions. We love introducing companies to you guys. Our problem is everybody we know is tech and they all tell us they're already on the platform. So it's like, if I get like 1 out of 50 to tell me they're not already your paying customer, I'm like jumping up and down to make that intro. But so we'd love intros from anyone listening to, for that. Um, you guys are the ones digitizing everything and just making it better and more cost effective and adding new bells and whistles every day. I'm excited to hear more about how the shred thing, totally plays out. Anything else you want listeners to know before we close up today?
Yeah, massive shout. You've mentioned it a couple times, us doing more with less. And I just wanted to like give a huge shout out to all the people at Humi, a year and a half ago. And in that year, grew our revenue 50% more than the year before and burned 50% less capital. So just a huge, just for everyone listening, like these companies don't happen, they aren't driven by a single person. It's a
Yeah.
crazy number of awesome people in the background doing lots of hard work. And just love to shout the whole crew out before we, as an ending note here.
Yeah, I think it's huge because sometimes people just get into this mode of I used to work at Uber, where when you're bringing them up, I was thinking that's a once in a generation company. Like no, like I don't delusionally compare myself to Bill Gates, and startups shouldn't say I'm gonna have what she's having, and I want the same super voting shares that Mark Zuckerberg has. You know, so I think the fact that you guys were able to do it shows that it can be done. You can really cut that burn and you could still deliver that kind of revenue growth, which is pretty amazing while still dealing with new product stuff. So I find your updates amazing. And I know you've got a third child on the way. So you have to start paying attention to sleep at some point too. That's part of your objective for the year.
Third time around, I'm pretty comfortable with zombie.
Okay, I'll bet you are. All right, Kevin. Great to see you. Thanks for coming on the pod. Talk to you real soon.
Thanks for having me, Andrew.
Okay, bye for now.